SBC Media.
Brazil, a global economic powerhouse, deeply passionate about sports, and now home to one of the hottest markets in gaming. And we're giving it the full SBC treatment. Join industry leaders, market experts, and all the major players in the country for 3 days of content, exhibition, and epic networking at the first ever SBC Summit Rio.
SBC Leaders connects the gambling industry's top-tier operators and associations to share the best ideas, collaborate on solving the biggest issues, and push innovation throughout the betting and gaming industry. If you're an operator and want to join the discussion, visit sbcleaders.com for more information.
Last week, alongside the publishing of its Q3 results, Catena Media announced that it had completed its 18-month-long corporate strategic review. A year of deal-making that sees Catena generate €76 million from the sale of European media assets, as proceeds will be used to shrink debt and strengthen its long-term commercials prospects in North American markets. As such, a slim-line Catena will now focus its entire business strategy on North American growth, in which the company continues to shift its commercial model onto rev-share based contracts, deemed better for long-term cost controls and sustainable growth. 2022 and 2023 bear the deep scars of Catena's transformation, as Catena takes its biggest gamble, placing all chips on North American growth. And this will be the focus of today's episode of iGaming Daily, sponsored by SBC Summit Rio, where I am joined by SBC's content director, Edward Menway, and SBC America's senior journalist, Charlie Horner, on Monday's episode. How are you both doing? Did we all have a good weekend?
Yeah, great weekend. Yeah, but you know, what more would I rather be doing than starting the week off by dissecting Catena's Q3s?
Yeah, you know, it's a start of the new week, but this broke last week, and it's big news, so it's good to delve into it. But Ted, do you have a good weekend?
Yes, gearing up to the Christmas spirit, James.
You sound so festive right now. You sound so cheery.
No, it's kicking off. Yeah,
it's like Elf on a Shelf just didn't brighten you up.
Mm-hmm.
My weekend was pretty good as well, after getting over the excitement of Garnacho's overhead kick for Manchester United yesterday. But no, ready to start the podcast, and we'll delve straight into the topic of Catena. And Ted, I'm going to come to you first. I know we just did a very brief overview in the introduction, but can you just give us a bit more clarity on what's been happening on a European front for Catena?
Yes, so Catena completes an 18-month-long strategic review. And pretty much from the offset, I think Catena's been divided between US growth, its approach to US growth, versus the realities of operating a media network in saturated European markets, and its exposure to grey territories within that network. And pretty early on, it said that it was going to revise its European media assets, and it implied that it would sell a lot of its inventory. I'm actually quite surprised. I think a lot of analysts are quite surprised that it went the full hog and sold every European media asset under its portfolio. But the main ones of them are Ask Gamblers, I think for $45 million. And last week, he completed the sale of Super Scamesi, which is a heritage Italian betting portal, for $19 million. Its latest round generated $76 million in proceeds that will be used to shrink its debt. And that shrinkage is needed for Catena to kind of revise its operations, revise its cost controls, and re-strategize for North American growth.
Mm-hmm. And you just briefly mentioned about his debts then. Before we move on to kind of get the North American perspective, how have Catena Media got themselves into debt to the point they have to sell off the assets to pay them?
Okay, so it's, again, how does a company get into debt? It is a complicated question, because you've got to kind of revise its whole history. Now, Catena, when it was going through its first expansion phase, it leveraged a lot of debt to acquire assets, and to acquire a portfolio that just wasn't affiliates. It was across a lot of different media units, finance, high-risk loans, and the initial process of its strategic review was a revision of all of its media portfolios, so all of its units under its media umbrella. And in its first shrinkage, it went back to refocusing on gambling. And from that now, it's just fully focused on North American gambling. Countering, if you compare it to other affiliate networks, you could say that Catena's growth has come has been more focused on M&A than others.
And again, we mentioned in the intro that this announcement came alongside its Q3 reports, and we've just mentioned the shift in their focus from the European markets to North America. But I mean, the report wasn't very pleasing for its North American progress. And Charlie, just want to delve into a bit of that.
Yeah, I mean, as Ted mentioned, the last 18 months has seen Catena really shift its approach to be more North American centric. But Q3, which it must be said is traditionally a slower part of the year for affiliates in the US, the Q3 revenues in North America declined 29%, which was roughly similar to the total revenue loss. The declines in revenue year over year. But that's because Catena's business now is majoritively made up from North America. I think the region accounts for 84% of all corporate revenues. So it really breaks down and highlights the shift in strategy, really. Which I guess is born out of the fact that the US, for many businesses, operators, suppliers, affiliates, is that bastion of opportunity, high growth over the last few years. And I think affiliates are maybe looking towards the online casino side of things for future growth, because the sports has launched in many new markets already. 2023 has been quite slow on the sports front. So I think they're probably going to look towards online casino for future growth in the US.
Mm-hmm. And Catena also, they changed the contract with operators from cost per acquisition to revenue share deals. First off, just for the listeners who don't know what that is, can you just explain what the differences are and why they decided to change that method? Yeah,
so the decline in revenues has been attributed to the fact that these contracts have been changing from CPA to rev-share. And what that means is that the CPA model is you collect payment up front for the players that you distribute to the operators. And that doesn't change based on whether they gamble $10 or $1 million. You paid a fixed rate, essentially. With the rev share, you gain some of that revenue that the operator makes for the entire lifetime duration of the player, which obviously incentivizes the affiliate to send more high value players to the operators. And it means if you can do that positively, it's going to generate more long-term sustainable revenues for the affiliate rather than sending loads of low-value customers. So that's what they've been doing, and that's obviously changing from the rev share. Changing to the rev share has sort of hit the CPA rates, and with it being a slower season in the US, operators are less willing to pay high CPA rates when there's not that many new markets launching.
And I'm going to put this one out for both of you. I know, Ted, you're quite European-centric at the moment in this conversation. Charlie's the North American face. But what reality is Catena facing now they've shifted their full focus to North America? Because it's a bold move. So just your thoughts on it, Ted. What the realities are they facing?
Charlie can contest these if he wants, but I think we're entering year 5 of US gaming post PASPA, and it's clear that the market makeup has kind of molded, and in that you've got 2 operators that are really at the front of the pack. So the customer base has kind of shrunk. So when you got FanDuel and DraftKings, BetMGM too. So I think this actually has shifted, or is one of the reasons why it's shifting to a rev share model. It's looking kind of for more long-term sustainability, but you also as an affiliate network have to feed the or deliver customers to the partners within the market in that field is shrinking. And it's the reality of the US market. However, in terms of what was Charlie was saying quite right, it's that it is the growth market. It is where you're getting kind of new customers. They are spending on sportsbooks, spending on online casino. And that goes against what is happening in European markets, where that percent, it's getting harder and harder, especially because of the regulations coming in, compliance controls to kind of eke out percentages out your player base. And it's not the first company to transition to a rev-share model in the States. Its main competitor, Better Collective, did that a year before. That started, it put the wheels in motion. Then it's completed its full migration onto rev-share models, pretty much of its whole player base. And Catena's kind of catching up in that department. Also, when you break down the number of affiliates, it's very much in the first phase of doing this process. I think it came out to about 17% of all its current customers are on rev share models. So it will be an ongoing transition, and I don't necessarily think that. I think that that's going to transpire into early 2024. So this, as an ongoing process, I don't expect the full recovery of Catena Media to come in 2024 because of this big migration to rev share models.
Yeah, I guess Ted is right that some of the factors are changing in the US with FanDuel and DraftKings sort of dominance. Even as we enter year 5, some of those mature markets are still growing. So Pennsylvania in October posted a record for monthly handle. We saw similar records in Louisiana, and revenue records as well. New York, a less mature market, but that posted $2 billion in handle in October as well. So there's a huge growing appetite for sports betting in the US. And the debut of these more challenger brands, your Fanatics and your ESPN bets, that's going to really drive up competition in that market, which can only come to help affiliates in the long run. I'm not entirely sure if Catena actually serve Fanatics and Penn. I don't believe that they actually are clients, but you can see the indirect benefits from other operators who will be competing against those brands in a bid to get new customers.
And also, to Charlie's point, one of the reasons why Catena needed a transition to North America is just the market reality of Catena is a growing company. It's growing its media assets, and if the end goal is for that company to be sold and the investors want to flip a high value M&A, it's not going to get that in Europe. And that's the market reality. It's much better off just gambling everything on US growth, going out to market and saying, look, we are an established media network for sports betting in the US. Who's going to take us there? As you see, if you compare the North American market in terms of for iGaming media versus the European, you're not going to get any media launches in Europe. It's too saturated. And also, you're not going to get any M&A activity in the European media. So the appeal there is we want to be attractive in the US market because that's where the deals are being made.
Yeah. I was going to say this shift to the North American focus, it sounds pretty damning for the European market. I know, Ted, you just briefly touched on this, but is that the case now? Is the prospect of a Catena Media affiliate-led company, there's just no prospect now in the European market at the moment? Or is it just a comparison to the North American market?
I think for the iGaming media PLCs, that is a reality that if you have high European exposure, your margins are being cut. And that is reflective of what's going on with the operators too. However, I think that, again, this isn't just happening with Catena. Like gambling.com are going for a much higher US exposure. So are Excel Media. The one company that's kind of managed to strike it out in geographically is Better Collective. But again, I think they got much bigger resources. They're formed of a much better kind of organic structure than their competition, and they're much better at kind of leveraging those advantages. But it doesn't mean that the game is over for the other affiliates. It's just that they have to be much more localized, much more focused to one-on-one strategies with Europe's individual markets. And they also have to kind of keep those kind of cost controls down. So the way they kind of acquire players, they've got to do it. They've got to kind of control kind of volume to cost controls. And I think that's much more important for European operators. So it's much more of a cost game. And how many customers can you send? How effective can they be? So I don't necessarily think it's over for the European market. It's just much, much tougher. And then the other thing here is like, what is the end goal for any kind of European-based affiliate? Because the longer this grows, the longer you kind of drag on in business, the lower your market value is going to be, because it's reflective of the overall market and what it's going through.
Mm-hmm. And we mentioned this come from the end of an 18-month corporate strategic review. Is this now officially the end of said review, or do you think there'll be more to come from it? And what else has come from this review?
So, yeah, I mean, I'll jump in and answer this one. This is the end of the strategic review, which was really implemented just to see review that European portfolio, explore that North American opportunity, deleverage the balance sheet, and it's done that through the sales of assets that we've already mentioned. I think Ted mentioned they've raised 76 million euros to deleverage that balance sheet. The conclusion of the review came with the sale of the Italian business. But I also think Ted was right earlier when he was talking about the long-term plans. What does Catena want? What does leadership want? What do their investors want? You're always looking towards the long term, and you're happy to take some short-term headwinds if it means that you're going to get long-term gains. That opportunity is in North America. There's a lot more M&A activity going on in in North American markets, than European markets. So if your end goal is to be bought out or something like that, then you want to be in those markets where there's a lot more activity. And this strategic review could be in part to help drive that process along.
Really good points brought on there. I think this review is ongoing, even so, and I think it's being led by the investors of Catena. And the end goal there is, how do you make Catena an appealing asset to big kind of North American media owners who will want to purchase the company at a premium? And I think that the days of these affiliate media portals that have 100 websites are kind of over. I think if you're a media PLC in iGaming, you're probably looking at about a portfolio of 10 or 12 sites that are effective, that generate traffic at certain values, and that can actually, and this is the other thing about the transition to rev-share models, is that they are effective on the commercialization of those contracts. So they're not looking at CPAs anymore, and they can feed their media partners. And again, you're coming into a US market where, ESPN are launching their own sports betting properties, but I think a lot of kind of the other big media platforms in the US, they're looking at how do we get in that game, in the game, servicing these big sports books. And they would, do they look at Catena and go, yeah, that is an attractive proposition for an M&A?
And rounding up the podcast, let's look at the long-term outlook for Catena. Let's look at the positives versus the negatives. And we'll start with the positives. And Charlie, do you want to give because they're entering the North American market, and you said it could be a positive move for them. Do you want to give your views on that?
Yeah, I mean, it might not be as fast as in previous years, but there will be new markets. There will be, hopefully, more online casino markets that are opening in the next couple of legislative cycles. And I do think the shift from CPA to rev-share models, that's the positive, because you're going to get continuous regenerative revenue streams. So I think there are positives. I don't think Catena leadership would be make any arguments to say that it's been a tough Q3, a tough 2023 in total. But I think there are more medium to long term gains to be had if they stick on this strategy. Don't know if Ted, you've got anything to add to that as well.
Look, I think coming from a reorganization now, there's going to be a lot of pressure for Catena to get those numbers right. To have positive quarter-by-quarter growth. And I actually think that they really don't. They should actually go, yes, it is important. They're going to have shareholder pressure to do that, but they've got to kind of pitch a stronger long-term game. And I think from there, it's really about kind of your KPIs, how effective you are moving on to this revenue share model. But overall, it's now going back to, look, if you simplified your portfolio, how effective is it going to be for those market partners? And can they build like a real rival to what Better Collective are doing in that market, right? And again, I think the US market will soon mirror, in terms of the affiliate model, it will soon mirror its what's happening at the operator level, where you might get, it might just become a 2 or 3 player market taking X% of revenue share of revenue share contracts and just feeding a set specific number of players. And if you are one of those two or three US media partners, you're going to be worth a lot of money. So I think now, look, forget about your quarterly reviews, right? Just focus on that kind of 2 to 3 year strategy and whether you can get it right.
And let's do the complete opposite of what every podcast do. Instead of ending on a positive, let's end on a negative. Charlie? I
mean, just look at the KPIs from the Q3 report. Revenue down, EBITDA margins down, new depositing customers down. So those short-term immediate KPIs are not looking healthy. So if you want a negative, just look at that first couple of sheets of the quarterly report. I don't want to go in too hard, so.
My negative here would be the US market reality of, yes, they have to feed a smaller number of operators, but in that, the relationship becomes more complicated, i.e., who's got the control over the acquisition affairs for the big media partners. And it might be that, I'd like to flip this to Charlie, where, say, an ESPN bet or a Fanatics comes into the market. Now, are they going to be as aggressive as what we saw in the early days of the US market, where it's high CPA, a high percentage on revenue share models just to get the customers in? Or do these companies believe, like, heck, do we actually even need an affiliate model when we got the broadcast network and we got the second biggest apparel company in the US? And again, you've got companies that are much more aware of cost control. No, Charlie, I think you're right, because I think the US market will reflect, especially in terms of its media plays. And with ESPN and Fanatics coming, it will become a kind of friends and frenemies marketplace. I mean, you do all these deals, but at the same time, you know that you can get screwed over at any time. So interesting days, yeah.
Yeah, I guess to answer that, yeah, Fanatics and ESPN both have huge customer databases, very linked to the sporting industry, sports fans first and foremost. So you would imagine that you can activate those users or a sizable percentage of those users. So is there as big a requirement for a sizable affiliate business? Yeah, you can question that, but I think generally they're happy to spend because they want to catch up with market share, particularly around those big sporting events in Q1, Super Bowl and March Madness, namely. I think they'll spend quite heavily then. So I think there is an opportunity, but yeah, I think it's not going to be as crazy as it was in the early days when everyone was fighting for early first mover advantage.
Yeah, I'm sure SBC Americas will be keeping a lookout for them friends and frenemies kind of future going over the next 12 months. That's all we've got time for on today's podcast. Any related articles from SBC News and SBC Americas, we will leave a link in the description below. Apart from that, Ted, Charlie, thank you for joining us on Monday's episode of iGaming Daily. To the listeners, I hope this was an informative start to your week, and you'll hear from us tomorrow on the next episode of iGaming Daily. But until then, thank you and goodbye.
SBC Media.